All right. Yeah, I hear snoring. Somebody nudge him. So let's say we have John and Jane, and John and Jane are in their 50s. They're making a combined income of about $180,000. And they meet with a financial advisor. They've done a good job in accumulating assets. They've put money into pre-retirement, pre-tax accounts. They have brokerage accounts. They kind of have a plan in mind of what they want to do when they retire and what they're going to receive. And based on their projections, they think they should be able to keep about the same income stream, and that's when they're 65 or older. And they'll get about $50,000 from Social Security. They'll probably withdraw about $60,000 from their IRAs or 401ks, and then they have brokerage accounts that they'll manipulate, maybe take another $60,000 from. What do you guys think? What tax amount do you think they would owe if we just use today's tax rate? Because they're in about, I want to say it's like the 22% bracket. 24% bracket. So you think they'd owe about $24,000? Because that is, you start thinking about it when people say I'm in the 20% bracket or I'm in the 25%, this is where I'm at. That's what you're assuming. The software shows if we used at 65, their $34,700 is just the standard, and they both get that little increase of the $1,600. We can use part of the senior deduction because they don't get the full amount, right? Because they're over the 150, but they're only 180, so they didn't actually phase out completely. They would owe about $11,900, and they've actually given up 6.62% of their income. So it isn't quite as bad as what you believe you are in for this tax bracket. What is the important part here is the standard deductions that were increased in 2017 allow us to have a lot of our income not be taxed. So here, I would say to them, that isn't too bad. You're giving up $11,900 of $180,000 to taxes if things continue the way they are, because I'm basing this off current. But what if we took a portion of their assets in their portfolio, and instead of withdrawing those funds from the IRA completely, if we had cash value life insurance or we had a Roth in there, and we actually manipulated the numbers to try to lower their taxes, what do you think I could get it to? From $11,900. Same income. I'm not going to tell them, oh, we're going to keep you at a lower tax because we're going to take less income. We're going to pull that same 180.
About 3,000.
How much?
0.
Oh,
No,
I'm not that good.
about 3,900.
Oh, 3,900. Okay, so in between, I'll say in between 0 and 3,900, all right? So if we pull from that, I can get them to less than 1% with the same thing,
That's pretty
right?
good.
Man, we definitely need to talk.
And this is where you love to be able to tell people that, hey, if we just change where we're pulling income from, you actually won't give up as much money to the government. Your assets might actually last longer for you too, because you aren't having to withdraw as much, right? Maybe they're withdrawing 180 because they know they have to give that money up, a portion of it.
Excuse me.
Yep.
You need an intern?
So, no, I love this concept. It's one of the things I talk to my kids about. I mentioned my kids, 25 and 26. When they were in middle school, I was talking to them about Roth IRAs, right? And saying, oh, if you earned that money, we have to put a portion of it in this. The embarrassing part of this is when they would bring friends over to the house, they would say, Mom, so-and-so's parents haven't explained to their kids what a Roth is. Oh no, this is the embarrassing part for you. But it is true, the earlier you start by, my kids almost think that they have to do it now. I don't think anybody's told them you really don't have to, but it's going to help them in the long run I call it pay to play, right? Pay your taxes now so that you can play later and not have to worry about what your taxes are in the future. So I do want to give you proof. I don't just want to throw this up here and say this is what I was able to do. The software that we use that I can run for Randolph, it shows a client, hey, this was your original plan. You would have reported around $172,000 with adjusted gross income. And that's because Social Security will never be 100% taxable unless they change the tax laws. Social Security is still tax advantaged income. So I do want you to think about that. That income stream does still, at the max, it's going to be taxed at 85%, not the full 100. So if they came in, did what they originally planned, they would only take about $44,000 of deductions and exemptions, and they give up $2,700 because they were over that $150,000 phase out right now. We were able, because we didn't use all of the IRA traditional money, we used some of it from life insurance or Roth, we were able to keep them under that adjusted gross income amount, so they got to take advantage of the full $12,000 senior deduction along with their $34,700 of just the standard. The other cool part of this is it made it here, so a full $65,000 remained in long-term capital gains 0 bucket, where originally that IRA money only allowed them to get 18 of it at 0 and bumped 41,000 of it into that 14%. So this is just saying, hey, I get the same income, but I'm gonna draw it from a different asset to help me actually organize and make sure I pay the least taxes possible. So potentially, like I said, could save people $10,000 either to have more fun, go play more in retirement, or withdraw less from your accounts and make sure they keep up with your longevity. Because all of us are living longer, right? We all need to make sure that we have these funds set aside and that we aren't withdrawing too much. I've mentioned this a couple times. Should have given a quiz. Name the 3 things, get a free piece of cake when you leave.